Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really glad to have with me once again the most frequent guest on this show. This is the most frequent guest this show has ever known, Michael Oliver. Thanks for joining me again, Michael.
Great to be back, Jay.
Always good to have you, and I want to tell our listeners before we go any further, it's olivermsa.com, olivermsa.com, to follow Michael and to sign up for his newsletter. Michael, during the final days of 2016, I understand you will be issuing some reports on the four major exchange-traded categories. I believe those are debt, stocks, commodities, and foreign exchange, with ideas as to which of these markets are poised to produce the largest percentage moves in 2017. Now, you've told me that you do not see gold or gold shares as the only major arenas of interest in 2017. Instead, you see major linkages between all four categories. Can you talk to us a little bit about those linkages and where you think things might be headed? Which items might be headed up, which might be headed down?
Well, I think that the moves have already started. We've had sort of a prelude. The only one that seems to be deceptive in that regard are U.S. stocks, S&P, Dow, and so forth, which are, put them in, let's start with them, equity category. You have to differentiate between developed market and emerging markets, and even in the developed markets, you have to look at Europe, Japan, and the U.S. and see a stark difference. Bernanke said years ago, one of his goals was to drive U.S. stock prices up. It was one of his policy goals. Why? To create happiness and bountiful joy, and spending. Not saving, but spending. I think he succeeded. And I think that the S&P doesn't know it yet, but it's clearly slowed to a crawl. 2 years ago, 24 months ago, December of 2014, S&P was trading at 2093. We're right now 8% above there. So you divide it by 24 and tell me how much joy that is. Okay?
Yeah.
It's marginal. And in 1-2 bad days, you can erase that, and we know that. I'm not going to get real specific. We do have subscribers, institutions, and high net worth investors who pay for the specifics, but I can give you some broad notions about our assessment of likely trends for 2017. The S&P, we think, will cave. All it has to do is sneeze about 3% to the downside. And as far as we're concerned, we start to get into a minefield of negative numbers. Okay, let's go over to the more important categories. And pardon me for slighting equities, but as far as I'm concerned, it is less important. Debt category, government specifically. The government bonds of the developed market, Japan, Italy is what I'm really focused on in Europe, and UST bonds, have all turned trend to higher rates, lower prices. That trend change just occurred a few months ago. So it took us till the first half of the year to continue upward in price, downward in yield, and then finally a few months ago that changed. And it didn't just change on a short-term basis for us, it was a long-term trend change, and therefore we're looking for higher rates as far out as we can see. And we think it could be pretty dramatic. But that only just began. So 2016 really hasn't had a chance to display the negative impact of higher rates yet. We think that will be exposed as we get into 2017. So there's a major asset category that has only just begun. Okay, commodities. The metric we like best for the overall basket is the Bloomberg Commodity Index. It's a well-balanced index, similar to the CRB. It's not like the Goldman Sachs, which is heavily weighted to energy. It's well-balanced. So far this year, as far as we're concerned, Bloomberg has broken out upside on annual momentum. And that's not a minor statement. You can have 3-month swings and 6-month swings, but when you break annual momentum out, up or down, you're generally talking about the next couple years. As far as we're concerned, several months ago it turned up. It has gained some ground since then, and net on the year it's up more than the S&P. I think it's up about 11.5% on the year right now, and I think it has only just begun to rise. The stars so far in commodities this year were gold, silver, although they've had a sharp pullback, admittedly. Gold miners, lump them in there. Sugar and oil, particularly oil. And energy products. They've taken the forefront of that particular asset category. Oil is up 46% on the year right now. Compare that to the S&P. However, next year we think that the new stars within the commodity complex will be the laggards, the ones that laid on their back all year. And that would be meats and grains, particularly the grains. It'd be corn, soybeans, and wheat. We think they could easily have a 40% year. Again, specific numbers that trigger those trend changes are in our reports. But we think next year the back end of the commodity category wakes up, and that Bloomberg gets another push upward, big. Now, again, linking. If the commodity index is turning up and the bonds are turning down, meaning higher yields, lower prices, that makes some sense, doesn't it? It's bonds, the higher rates, which some equity bulls would like to assign to the prospect of a stronger economy. What if, in fact, the higher rates are the prospect of inflation, particularly led by commodities, which I think is probably the more likely case? And I think, therefore, the downturn in T-bonds, higher yields, the upturn in the Bloomberg Commodity Index go hand in hand, and both reinforce one another's new trend direction. Then we have the very sleepy asset category, and I say very sleepy. The dollar index, which is a basket of major foreign currencies that trade-weighted, of which 57% or more is the euro. So we look at the euro and the dollar index, and they have been deadsville for almost 2 years, certainly a year and a half, to where the range of price action in those two currencies has been about 10%, and it's been both ways constantly, up, down, up, down, up, down. Recently, the dollar made a marginal new high out above its 2015 high, which was just above 100. We got to 103.50 or something. Right now it's 103. And the euro went down and tapped out timidly, this is a few weeks ago, its lows of the last year and a half. And nothing happened. It was they blew the top out and the bottom out, and they didn't go anywhere. And we think those were false price chart actions, preludes to reversals back the other way. And again, it won't take much in the terms of dollar index decline from current levels and euro upticks to fully change the annual momentum trend of those two major currencies. And if it does happen, and we think it will, and we provide specific numbers, but again, it's a sneeze away from where we are now, you will awaken the foreign exchange markets, the big currencies in the foreign exchange markets. And finally, Forex will become a wave-creating factor among the other asset categories. Commodities so far have gone up without any help from a weak dollar. Gold has gained this year without any help from a weak dollar. Imagine if the dollar got weak. So, again, fitting all these four asset categories together, and now, fortunately, for investors, high net worth investors and asset managers, there are two major areas you can go to access these markets. That's the futures or ETFs. Mm-hmm. So we think 2017 is going to be a heck of a year, and we think to some extent the prelude has already been given in 16. And it won't take much to sort of complete that in 17 and lock cinch the new trends in play.
Mm-hmm. Well, ETFs, of course, give smaller investors a good chance and opportunity to get involved as well, either on the long or short side.
Correct.
So that is really something that's helping, I think, smaller investors as well. I want to ask you, you talked about annual momentum being so important and really signaling a longer-term change. We've seen an annual momentum change in gold, too, I think, right?
We saw that early this year, and as far as I'm concerned, the pullback, as sharp as it's been, it does not negate that in the least. And we strongly suspect that the minor upturn you're starting to get now, we're about 2% off recent lows, is probably the beginning point of an upturn. If gold, for example, were to rally another $20, $30, I'd say you've seen the low. Mm-hmm. You've seen the secondary low, which is the low we made several weeks ago. And is back on course for a good 2017. So among commodities next year, my guess right now would be the strongest areas to be would be gold miners especially. We prefer gold miners over gold, by the way. We have for a year. And grains. Those would be the two focus areas we would look at. I tend to think that oil, which has had a heck of a year this year, will not have such a great year next year. Not that it's going to collapse or anything, but I think it's going to run out of gas, probably go another 10% higher before it does, but still a good chunk of its move has already occurred. Therefore, if you're joining on that train, now you're joining late. Grains, it's a different story, and gold is giving you a second opportunity here.
Right. With respect to the food items, you talk about meats and grains. You see them as being very strong in 2017. Michael, I have to think that if we start to see an uptick in inflation, that's going to cause some political discontent, no doubt, among lower income groups especially, and it would put a lot of pressure on the Fed, I would think, to reverse course, perhaps, especially if interest rates start rising. I mean, it seems to me somewhat like the 1970s, when inflation started taking off, interest rates went up, and the Fed tried to squelch or push down interest rates in a way to try to get the economy going and also to relieve pain for consumers. Do you see the possibility? I know you're mostly looking at the technicals, but from a political, economic point of view, is it inconceivable to you that the Fed may reverse course in 2017 and start printing money like mad?
That's an issue that's partly no longer like it used to be. There are enough political forces in the world that may not intellectually understand it, but do sort of on the surface understand it. Trump, for example, and some of the political parties in Europe who don't like what the central banks have done. Now, Trump is surrounded by some people who have some brains and who understand this on an intellectual level, academic intellectual level, and who are opponents of what the central bank has done and therefore opponents of the Fed. Some of them would even like to abolish it, which wouldn't be a bad idea. But the point being that the question is, once things get derailed again, the confidence factor of the general public and the investors in particular in central banks has diminished. So what the central banks may or may not do may not have as much impact as it otherwise would. Plus, some of these political forces that are coming into play in Europe and here could hamstring the central banks next time around. But still, I see that what they've already done, the motions already under the tectonic plates already that are in motion, are enough to drive the commodities upward, equities downward, and so forth. It's not like they have to do something more. They've already done it. The issue is unleashing and repricing assets where they otherwise might have been had it not been for their deliberate intentions and policies to price stocks up and keep commodities down and to keep rates low. So it's just the unwinding of their prior policies that could create these big moves with or without any future policy on their part.
Well, we'll have to leave it go at that, but 2017 promises to be quite an interesting year, to say the least. Would you agree with that, Michael?
Absolutely. It's going to be a great year.